Hello, everyone out there in YouTube land. This is Justin with Parody Chronicles with a new video, Beginner's Guide to Testfolio. So, if you haven't seen the blog post, on my Substack there, I have a post called 3 Portfolio Backtesters that every DIY investor should know. And that has the full layout of and the full description of my comparison of Testfolio and portfolio charts and portfolio visualizer. So read that if you want to have more of the background. But then I thought I'd make a little video to describe how to use my favorite of the 3 in terms of what I recommend for people getting started with backtesting. So here it is. I'm going to try to keep this basic, try to keep it, I don't know how many minutes, maybe 8, 10, something like that. And there will be more videos to come with how to use Testfolio. But this is really just to get you started with it. All right, so let me switch over to the website. Here it goes. Testfol.io is the website. And this is the page that you get sort of when you start it off. There is a login feature over here on the top right. Now you don't have to log in order to use it, but logging in allows you to save some of your work, so I find it can be to be pretty helpful. Also, while I'm at it, might as well explain this thing. This heart is for donating. This is a free site that works on some Ko-Fi donations and the like. So if you'd like to support the developers of this and show your appreciation for all the hard work that's gone into it, please do so. This is one of the best kind of DIY projects or DIY tools out there for people. So I want you to, I'd love it if everyone contributed to keeping it going. So here you go. This is the page that you start on. All the stuff on the top, this is more advanced stuff. And if you understand what all these are, you probably don't need this beginner video. So we'll just skip those for now. I do want to call your attention here to the About page. It's very helpful. And right here, you can click on the Help page, which has a lot about the tickers that's used and about the math behind everything. So this is a great resource for you, but we're just gonna kind of skip over that for right now. So we'll just start with the basics of how to add in your own portfolio. Okay, so all this stuff here you can leave blank. You don't have to put something in. The start date and end date, self-explanatory. If you just leave them as they are, they'll just go as far back as it goes. You can always change this. You can adjust for inflation. I assume all of that's pretty easy to understand, but you don't have to change anything. It can still work. So if I want to put in say I put in a portfolio, I'll go into Add Empty, and I will, let's say I'll call this my actual portfolio. Now, before doing this, I'd of course have to bring up my statement. I'd have to know what I had, and I'll just give you a simplified version. I'm just going to kind of do this on the top of my head, and I'll say that I have I kind of have basically a 60-40-ish type portfolio. I have SPY, I have BND. I can do mutual funds and ETFs in this thing. I can also do individual tickers. Let's say I own some Coca-Cola that my grandfather gave me, and let's say also I want to put in cash. This is a little good trick. If I just want to say that I have a certain amount of my portfolio in cash, then actually I use the ticker cash X, and that just will replicate the behavior of cash. So there you go. I put in my my assets. If you need more, of course, you just go to the plus thing, or wipe them all away with the clear button there. And then I need to get my percentages, which also I will have worked out ahead of time. And I'm going to say, I got 56% in that. Let's say 56.6, okay? And then I have 30.4, okay? And then I've got 7% in Coca-Cola stock, and I've got 6 there, okay? So just make sure it adds to 100. Some other tricks here, if you have a kind of equal weight portfolio, you want to test that, you can put in there those buttons. Now, some other buttons that you may need: rebalance. This is if you're going to work on your portfolio, or if you have worked on your portfolio, you want to kind of test it there. But I'm going to actually put in none. I just want to see sort of how my portfolio has done without me moving things around. Okay, so maybe that's realistic for you, maybe that's not. But if you believe that you have rebalanced yearly, you can put that in as you like. We're going to go for total return. Drag is usually a fee or a trading cost if you have it. Now, with many ETFs, I'm trading for zero transaction cost. They're totally free to trade. That probably is going to be zero for you, but if you wanted to add that in, you could. Rebalance bands is a little bit of an advanced feature that I can explain later. All right, so this is my actual portfolio, and I'm just going to go ahead and click backtest and see how it has done since 2007, April 10th. Now, I wanted to talk a little bit about this. Your portfolio backtest is always going to be limited by the youngest asset. And right here, we can see if I click on that black eye that the youngest asset I have is BND. Now, I'll show you later in the video how to kind of work around that. There's some things that you can do. But for right now, this is as close as, this is what has happened to your portfolio since 2007. If you started, investing in 2011, you could maybe put it in 2011. You could see, you could make the date be whatever you want as long as it is more recent than this here. So here you go. Now, another one here is I can always link this if I want to save this and send it to someone as an email, or you can just copy that link. Now, here are some of the statistics that are going to be most helpful for you. So, CAGR, compound annual growth rate, is probably the most important thing to look at. So that's how much you've made on a compounded basis since that time. So this is annual, this is cumulative over here, and this is your return. You then have a series of other stats. Some are more useful than others. To make this really simple, I like Sharp, which is a reward to risk ratio, where we just look at how much return we've gotten for the volatility. We're subtracting off a risk-free rate, which I can explain later. But this is a good measure of just how how much you got for how much volatility you took on. Sortino and Kalmar are similar. Another great one is Ulcer Index, and what this is just sort of a great number for looking at the volatility on the downside. How difficult was it to hold it? Volatility is just a measure of how things move around the mean, and that can include ups as well as downs. But the thing is, as investors, we don't have any problem with the ups. Well, we want a lot of upside volatility. It's the downside and how long that downside is and how deep and persistent that those downsides are, which are hard, and that's Ulcer Index. And later, again, that's another video. But if you focus on CAGR, Sharp, and Ulcer Index, you get three really good statistics for return, return to risk ratio, and then how difficult was it to hold that portfolio. You can also see some of the other things there. One other important place I go to is right here under withdrawal stats, and you have the safe withdrawal and perpetual withdrawals. Again, this is another video, but basically safe withdrawal is saying how much you could have taken out and still ended with more than zero, and perpetual is how much you could have taken out and still always have more than you started with. So there's some nuance there. I can explain it better later, but if you look at, I've got 18 years, so I can go up to 15 years here, and I can see that these portfolios would have survived pretty well in terms of safe withdrawal rate. I'll be right down here, and I see that almost all the portfolios are going to survive at those that you can imagine. All right, so here, for example, I could have taken out 8% from this portfolio over the past 15 years and still been safe. But anyway, that's your withdrawal stat. So between those three on the front page and withdrawal stats, you have a good look at a portfolio. Okay, a couple more things. That was my first task. Now let's say I want to adjust it, and maybe I wanted to add gold. So I'll show you how to do that. I'm going to clone it, and I'll say actual portfolio with gold, and now I'm just going to kind of randomly take off, let's say 5% of my stock allocation and 5% of my bond allocation. I'll add a new one, and I'll call that GLD, Basic Gold Fund. And now I got to make sure I put in the 10 there. And now we're just really seeing how would my portfolio have performed if I had that. I can backtest it and compare, and I can see, would have gotten a little more return, would have been less volatile, higher Sharp ratio, and easier to handle, a lower ulcer index. So you can see that that one little change in my portfolio over the past 18.73 years would have made a pretty big difference. Okay, so again, there you can copy, you can move things around, add, subtract, whatever. All right, so that was task number 2. Let's go to task number 3. Now, and this is really just a feature of the past month or 2 months, you can add preset portfolio. So maybe some of you are coming to this video from Risk Parity Radio, and you'll have Frank's golden ratio, which you can put in right there, and you can add that as another portfolio. So we're just going to see how that would have performed if you had that over the past 18.73 years. Then you would have seen some different statistics, maybe a little bit lower for CAGR, but much better Sharpe ratio, much more stable, and much lower ulcer index. So that just kind of tells you if you had that, you would have seen different results. So that is the presets. Those are awesome. There are 7 on here that you can play around with, and if you just click on them, you can kind of see what makes them if you don't know what those portfolios are already. The last thing I want to do, a little bit of an advanced technique, and that is to use what they called simulated funds, so sim versions. And you can see here there's sim versions. So I'll explain a little bit about what that means. Basically, those are reconstructed data sets for particular asset classes. So in this case, I have an S&P 500 fund for SPY, and I have a total bond fund here, and I have Coca-Cola, and I have cash. Well, what I can do is I can use simulated versions of a total bond fund or of an S&P 500 fund, and that will take the data set back longer. All right, so I'll clone this, and I'll go, I'll say long backtest actual portfolio. And what I'll do, in this case, I know them. I'll show you in a second how to find if I don't know, but I can add SIM to that, and I get a longer backtest and BND as well. And I put those in strategically because there are 47 different simulated funds, and they're listed up on the help page. And you can kind of use those to get an indication of how your portfolio would have performed even before or making even the data set longer. So you can watch here by putting in the simulated funds. I can now take my backtest all the way back to, oh, I see I'm still limited by something. What am I limited? Oh, I see. I have to remove this now because I'm still limited by this one. This is the youngest one in all of these portfolios. So I'll actually have to just, I can save it if I wanted to. And I'll just, in this case, I will just delete it and I'll backtest that. Sorry about that. And now I get, oh, something's still wrong with it. What is it saying? It's saying BND. Where's BND? I thought it just, oh, with gold. I see. Okay. Do that too. Now, try third time's a charm. Okay, let's see. So I'm comparing my actual portfolio. I can get back to 34 years. Now, depending on the simulated fund, they go back different amounts. But in this case, it's saying that KMLM, which is actually a fund in the golden ratio portfolio, only goes back to 1992, the simulated version, so that's as far as we can go. But now we can really see, I can compare Frank's golden ratio with my kind of portfolio, and I get these numbers. So you can see that the golden ratio portfolio returns a little slightly, just a tick more, but a whole lot less volatility, better Sharpe ratio, lower ulcer index, and I'm going to bet a lot better on withdrawal stats for how much you can take out. All right, so if you are interested in like what are those sim funds, how can I use them? Well, what you're going to want to do is go and add an asset. And let's just say I'll just show you what I had. So S&P 500, I've clicked that, and I can see there's the simulated version. I have other ones. I can do small cap value, and it will tell me that VBR sim is going to be my asset to use, or I can do gold. Okay, so gold GLD sim. So you kind of see how those work. Again, that's a little bit of an advanced technique, but if you play around with it, you can add those. Now you see here that these are portfolios all by themselves. So what I would do is just take note of what that is and then use that in your portfolio. Okay, and I think that's about it. Did I go through all my list here? I did. All right. Thanks, everyone. Let me know if you have any questions. Please visit my Substack, Risk Parity Chronicles at Substack. Okay, bye-bye.